P500. Um, well, I mapped that out right here. This is the stochastics, which I update every week. And you can see that we drew this range that we've been in for quite a while. And it looks like last week we were maybe going to the top of this range and maybe following this, or we could be falling into this range again, and the next stop is down here. We don't know. Right now, it seems like it's gravitating towards this level of resistance from before. But the big picture in general, there's a lot more money around the world to invest in America, and what's happening around the world is a lot of the economies in the world are not doing so good, and America is probably one of the best economies in the world right now. So there's recessions in Europe. There's all kind of problems with China. They're going to have recession, and they're trying to stimulate their economy. So right now, it looks like America is one of the best places to invest. It's been one of the best places to invest for at least 20 years, and right now, the central banks around the world are just rolling how the stocks are going. And let's look at our meeting notes. Okay, so we're December 23rd right now. June. Okay, June 23rd. Okay, we got end of quarter window dressing coming up in the next week. So every one of the good stocks that went up a lot so far, like Facebook and NVIDIA, a lot of the money managers want that on their books. So that's happening like in the last 2 weeks of June of the quarter here. And we have a July 4th holiday. So it's one of the more prominent holidays, because people have cookouts and memorable events around that time. So people know that the time around that is usually good. So that's why I have it green. We are super overbought in the stock market now. So we have, last week we were super overbought. Now we're at 76. So you can see we peaked last week. Now we're starting to go down in the stochastics. The time to buy is whenever everyone is fearful, and people are still super greedy right now. So right now we're still in a process of going down in the stochastics, and people are starting to lose interest. You can see the stock prices are going down, and I'm expecting it to go down to here or to here next. But one thing that we have here that we didn't have, way back here was we have momentum. When we have these lower lows and lower highs, we did not have momentum. But right now, over 50% of the S&P is above the moving averages. You can see these moving averages here. These yellow lines, purple, green, these are all listed here as moving averages. You can see we're trading above that, and almost more than half of the stocks in the S&P are trading above their moving averages. And that is really a momentum indicator. And it's hard to beat. Stock could go up, in a straight line with momentum, but eventually, it doesn't go up. The trees don't grow to the sky, so eventually it goes down. Right now, we have a process where the market's starting to go down again. So that's the big picture. Let's look at other things that could be coming up in the future here. We have June. We have the July 4th holiday. We have the Fed meeting in July, at the end of July. Now we have, July is usually July is usually one of the better months. So we're going into one of the better months of the year. And then we have 2 really bad months. So when we look at the calendar, we have this July 4th holiday is going to kick off a really good time in the stock market. And we expect, a really good time then. Then we have really bad months of August and September. And one thing we're keeping track of right now is last year, around October, we were noticing the home builders were pretty much making all-time lows. And we said probably at the end of the year, home demand returns. Believe it or not, the home builders are making all-time highs now. because there's a lack of inventory, and people that had interest rates of 3.5% aren't selling their house to upgrade because of mortgage costs. So we have this dynamic of strong demand for housing, and that actually came faster than I thought it would. And right now that'll help the economy because if people are buying new houses, they'll buy things at Home Depot, etc. Okay, so let's look at some more of our talking points. It looks like the Fed is near the end of their tightening cycle, but they could raise 1 or 2 times more. And whenever that happens, that's not good for the stock market if they raise more. But we do have over 50%, we'll go over this later on, of the S&P stocks over the 200-day moving average. And that's momentum. And right now we have, I give you 2 links right here in this. I'll send you this document. There's 2 links. That's the 58% above the 50-day, 55% above the 200-day. And so until like a month ago, we had only the 7 big tech stocks with 90% of the move of the S&P. Now the other stocks are catching up. That's really positive for making higher highs and higher lows. Let me see. We're currently overbought, so we expect the stock market to go down near term, unless there's something major that happens. We have interest rates going up, so that's not good for the stock market. And let me see. Okay, that's the big news. Let's look at some of these notes from Twitter. This guy, Dougie Cass, is really smart. He's a contrary thinker, and he's saying right now, selling all rallies. And he says the media is cheerleading the big 7 tech companies, and they're telling people to buy these. They can't go wrong. Just when that happens, you want to sell them. So right now we know we're overbought. People are still. Let's look at our fear greed is still extreme greed. And you don't want to buy whenever extreme greed. You want to buy when people are fearful. And we don't know what's going to cause that. But right now, you can always blame it on profit taking, which is basically selling whenever the hype is really high. So look at this one. It says, beware of the divergences in the market. Despite the rise in U.S. equities, this is a couple of days ago, the volume was down significantly and breadth is weak. So once you get to the top of these trading ranges, you have less volume, and especially on holidays. And then if the breadth is weak, then you start having this selling pressure down to the next level of support. So if you don't believe the hype, their thesis is all the big tech stocks are pretty much overvalued right now, and this AI is pretty hyped up, and it'll probably go down whenever there's a bad news story. But they said this guy thinks that Microsoft, the big Facebook, the big Amazon, the ones that have a lot of money to invest in this will do good in the AI. Most of the other companies won't. So anyway, so let's look at some this chart here. What I did was I plotted the S&P stocks above the 200-day moving average. That's this blue line there. And it's basically a one-to-one correlation with a little lag of the S&P 500. So as the stocks go over the 200-day moving average, you have momentum, and the S&P eventually catches up to that. So let me see. All right, so we're basically on the way down in the stochastics. So we're right in the middle, and we're right at the support level here of our channel. So I expect it to at least this to be like a level of support. We don't have any earnings for a catalyst for us to go higher. So the only thing we can do is just wait for these channels to get hit on the bottom and up. Now, where are we here? Crude oil is down to $68 a barrel. That's usually an indication of the slow global economy rather than like a supply-demand issue. So right now we have China slowing, we have Europe in many major European countries in recession. You see Ireland and Germany in recession, and so we have a lack of demand for oil, and that's why it's going down. And that helps inflation because that's the biggest cost input for products. So let me see. Inflation is going down. So next year, next month, it'll be 3.5%, and so that looks like it's under control. But the dollar index, it went up a little bit, and the gold went down a little bit. So these are inverse correlations, that seems. So whenever the dollar goes up, the price of gold goes down and vice versa. Let me see. That's usually the case. Let's look at Fair Greed Bureau talked about that for extreme greed. Just if you're skittish about the stock market and you don't want to, if you're too over your skis in a certain thing that you have money made in, this would be a good time to take profits because when stocks are down here, you're not going to get a good bid. Okay, so let's look at dollar index. It's going down. It's still going down in this channel in the straight line. So that's good for stocks. That's a good 5 or 10%. Whenever the dollar goes down like that, that gives a 5% push to earnings for multinationals because they that's just the way it works. All right, now VIX it's going up a little bit, but in general, it's super low right now. People are not afraid, and it's a bull market. People are just this is the time when most traders sell, and they would tend to sell right now. And whenever the VIX is low, and when the VIX is high, they start buying. So right now, you have to think the opposite. We're still in a position where we still have this media attention about the big tech stocks doing really good. The S&P's up 15%. Everyone, front page story, bull market. And we're basically right here coming down. We went down a little bit this week, and pretty soon we're going to be introducing fear into the market. Maybe not capitulation, but be ready for these emotions, and don't get sucked into selling whenever everyone else is selling. Okay, I think it's a good idea every once in a while to review some of the biggest mutual funds and the most successful. What I'm doing is I'm going to review Fidelity Magellan and Contrafund and T. Rowe Price Blue Chip Growth. These are ones we've reviewed like every 6 months or so, just to see what's added and removed from the portfolios. One thing that I've noticed, is that big tech stocks, a lot of these funds are basically moving away from some of the ones they've held for 10 or 20 years. They're trying to diversify into other companies. So you can see that Contrafund still has a large position in Meta, and they just started a position in Berkshire Hathaway, which is more conservative than some of the higher PE ratio stocks. A lot of these mutual funds are buying a lot of Microsoft. You can see 13% in T. Rowe Price Blue Chip. That is amazing. And Apple is 11%. That's pretty bold, and it's amazing that they didn't. They only had a 5% at the beginning of last year. So but a lot of times when stocks are out of favor, like at the beginning of this year, like Nvidia was super out of favor. We noticed in the same report that the mutual funds were accumulating Nvidia. So the reason I look at these are stocks you can basically buy and hold, and they'll grow at least 10% a year, because money managers, like mutual fund managers, they have unlimited resources and they keep track of these things. And a lot of times, if they're holding it 10 years, it's probably a good stock. So the one interesting one I see in here is Eli Lilly. That was never in any of these portfolios. And Eli Lilly has a weight loss drug that's supposed to be a blockbuster, and they have a Alzheimer's drug that might be released at the end of this year as approved. So let me see what else is here. Okay, so it's all, and the ones that were removed or reduced are in red. So you can see that Magellan is starting to reduce their holdings in, well, not noticing, in Home Depot, in Amazon, Apple, Google. It's amazing that they totally got rid of their Google position, which they've held basically for 20 years. So that's whenever companies or mutual funds start removing them, you have to look at those positions closer. That was a really big position for them. That's like at least 7%, 5%. They've held this. Yeah. So that's Magellan, and they're getting into Thermo. This is a scientific, a lot more diversified away from tech. They had a huge tech growth portfolio. Now they're diversifying into this is like scientific instruments, Costco, which is more of a dividend stock. I don't think it's a real growth stock. That's Lin Energy. They do hydrogen gas. And DHR, they're another biotech supporting company. They make devices for biotech, I think. And United Health, we've been following that for a while. And you can see that they had a position. Yeah, they still have the same position. But a lot of times, this 7% holdings turns into an 8%, not necessarily because they buy more, because it's gone up a lot. All right, so it's good to go through that every now and then just to see what smart money is doing. And all right, let's go to the next little thing. I did a screen using Fidelity. We do the screen every once in a while just to get ideas. And what I did with my screen, I'll show you. What I do is I go like this, get the peg ratio. I copy that, I put it into its own column, use special, and then I sort. Okay, and I highlight the best peg ratio stocks, right? And then you can see that they're a certain color, so I know that that's the best 27 of our 100 stocks. So I did that for every one of these, and then whenever we go back to okay, so after we highlight all those and do an order again, sort. Okay, so what we have is just the green ones are the best, of the group. The red is the basically be cautious about, and the yellow is good too. That's like the top 40 instead of the top 20. So what I do in my investing research is I look at the ones that have the most green. So this one, it's a buy, 8%, 27%. That's fairly valued, and then I group them into what sectors they're in. So we have tech is in blue. We have the orange is healthcare. So you can see sectors that are kind of undervalued, that are possibly quality and thrown out with the bathwater. So if you have all the insurance companies going down at once, maybe there's a diamond in the rough we can research to see if any that's worth it. So we see the sectors that look like best there's banks in here, Charles Schwab, UBS. We've been following Charles Schwab for a while. And we have tech, and we have banks, PayPal, and where's the banks? The banks are in purple. So we have purple in the banks. So but these are some of the undervalued, stocks that are quality that could be on sale. And let me see. So what I did was I picked out a couple of these to look at, just for kicks. Let's go to look at. Okay, what I did was one of these is ALB, Albemarle. They do lithium mining. So right now we know we have a huge worldwide demand for lithium because of electric battery. And so right now that's like when you look at a stock, you got to see like what's the catalyst, what will get people excited about this. And one thing, themes. Okay, it's a dividend aristocrat. That means it's growing its dividend over time. So that if you have a 1.8% dividend this year, next year will be like 1.38. And what that does is that allows you to, as you buy and hold the stock, it'll give you a better return over time. So that whenever there's inflation, there's a 2% inflation, if dividend is growing more than 2%, that'll keep up with inflation. So that's one of the themes. It's a dividend. They return to shareholders. Next one is EV demand for lithium. And the next one is U.S. Moving away from dependency on China. And the U.S. might invest in companies like this to maybe process rare earth metals or something, or make a more stable lithium supply for America. So that's the themes. Let's look at the forward PE. It's okay. This is forward PE is 11 points, so it's 12. So if we have forward PE, let's say 11, growing at 4%. I did these numbers here. It doesn't look like it's growing a whole lot. I divided this number by that number. I got 4%. And then I got this number by this number. Actually, between this 23 and 24, it's negative 4%. So I'm not sure why it's going down, but it's set to grow at 17%, 25 to 26. So it looks like we have like no growth. We have a very low PE of 11, growing at 7. Okay, so it's not growing a whole lot. This could all change whenever, say, one of their mines gets approved, or there's a funding from the government or something like that. But you don't want to rely on that. It doesn't seem like it's very compelling, consistent stock to invest in. We'll have to ask Mark about this next week, because Mark follows this stock, and I think he owned it at some point in time. All right. So another one in this list. Let's look back at this list. Is AIG. This is I noticed it has a PEG ratio of 0.49. That's like half off, if it's true. So I said, well, let's look at that. Most of the insurers have a PE of like 9. That's like very low for a PE. They have their profit margins and return on equity are what we're looking for. So let's look at their earnings summary for AIG. They're growing at 30% last year to this year, 15%, and then 11%. Then what's really weird is their earnings drop off a cliff in 25 to 26. So I got to look at why that's happening. Maybe they're selling, or their patent expires or something. That if you're a buy and hold investor, it's really hard to see something like that and be comfortable holding it. You have to research why would they go down so much after 20? Why would the earnings go down? Because they're basically an insurer. Why would the insurance business go down so much that year? I don't know, but so that's kind of sketchy. For me, I like to see like 12%, 12%, and 12%, and in a straight line up. And so this is kind of sketchy one. So I don't think I would invest in this. It's not really that attractive of an industry either. Insurance, because it's kind of fickle. if they do a lot of reinvesting, not reinsurance, and it's really hard to understand that. You know how much liability a company has dependent on what they're writing insurance policies on. So it's a little bit out of my league for that. So I'm gonna not. What I did do is I looked at some articles on this, and they did show AIG as one of the best growth at a reasonable price stocks that pay dividends. Okay, so here's what this article said. It said the stock trades with a P/E ratio of 8, and the average in the industry is 8.73. So it's not that great. If it was half of the industry's PE, that would be great. But right now it's like trading in line with other insurers. Their 4P has been high as 14 and as low as 7. So I guess you would want to buy it when it's closer to a 7 and with a median of 9. So their price to book ratio, I guess a lot of banks and insurance companies are like Berkshire Hathaway. Warren Buffett says their company should be looked at as a price to book, not that's the ratio, not a price to earnings. So we can't really understand these kind of stocks because it doesn't follow my pattern of low PE and low PEG ratio because you have to value these on price to book and beyond what I can understand. And then there's price to cash flow ratio for 3.93. So this is, I just don't understand this well enough to invest in it. It's just the industry is so hard. What I did do is I picked out the stocks that were mentioned in this article as growth at a reasonable price stocks that pay dividends. And a couple of these are actually insurers. So if you really know something about insurance, it seems like this sector is undervalued right now. One of the stocks that we said was undervalued was DHI. We were looking at this stock way back when they were selling these off. DHI. Let's look at DHI. This is DR Horton. They make houses, and they're basically making an all-time high now. Let's look at two things. Let's look at the chart. Two-year. Okay, this is when we were looking at it when it was like right around here. And right now we have a steady demand for houses. And let's look at their statistics and look at their, you can see like lower highs and lower lows. Seems like it's an uptrend. Let's look at the statistics on this. According to that, it's a growth at a reasonable price. That means the 4P is 11. And we have great numbers there. And so it's a PE. Let's look at the E-Trade. We're looking at the growth estimates. And here, log on. Oh no. Okay, we'll do this. Okay, we're gonna look at DHI. DHI. Okay, so we know the PE is 11. Let's look at the earnings projections. It's not that. Oh, yeah, it's looking pretty good. Hold on. There was a big drop from 22 to 23, but from 23 to 24, 11.14 divided by 7.26, we're going 1% from this year to next year. 1.26 divided by 12.29. Then it grows 9%, 12.29 divided by 13.4, 7%. So it's not that compelling. So it looks like it's barely valued. So the article, I don't know. It was better. It looked better whenever we reviewed it last year at this time. Okay, so let's look at the ETFs that are going up and down today. Change. Oil is going down the most. Let's look at pre. Oil is making new lows in. Let's look at this. Okay, crude oil is down another 1% today, 68. So I think the problem with the energy sector is the global economy is slowing. China is one of the biggest oil importers, and they are slowing down. They're in I think they're trying to stimulate their economy, and because of that, there's a lack of demand for oil, and that's why oil is going down. So oil is going down. Energy, conservative sectors. Let's look at what's going up the most. Home builders, construction. All right. So I guess when we look at, I think the stock market is like 6 months ahead of, what actually happens in the economy. So whenever we look at we made this comment like last 6 months ago, home demand will return. So home demand actually never, it has been consistent all year long. And the theory that interest rates affects new home demand is kind of, it was faulty. So let's we'll look back at the home builders next time they sell off. But right now they're pretty expensive. Are there any questions about any of that? Let's look at some of these other stocks that are GART. This is Nucor Corporation. They do steel products. UPS. Of course, would they be? I don't know what this company does. D.R. Horton, Qualcomm. This is one of the Qualcomm could be an AI play, and that's like a catalyst. They do components for phones, and they do intellectual property for cell phones. So I think there's a good chance that they might be in the middle of the AI chip situation. Eventually that could help. Right now they're one of the lowest PE ratio stocks in the big tech stock universe. Look at their statistics. They are PEG ratio of 1, so they're fairly valued. Their forward PE is 11, so that means, according to E-Trade, they'd be growing at 11%. So let's look at Qualcomm. One problem with Qualcomm is, in the past, they've had a hard time getting paid for their intellectual property. Like China uses their IP, but they don't pay for it. And now they're trying to diversify into other like recurring income products. Let's look at the revenue. They are not revenue. Earnings summary. That's pretty decent. They're growing like 10%. Let's look at 8.31 divided by 9.65. 15% from this year to next year. 9.65 divided by 7. 4% after that, from 24 to 25. Then 10%. So their PE is 10. They're growing like 8% averaged. It's not. And one big problem with Qualcomm is Apple is in the process of making their own components. And Apple used to be one of their biggest customers, and it's kind of a fickle um, demand for their products that they're selling to Apple. So I don't know. It's too iffy for me. Look at these earnings estimates. Goes from 12 to 8 to 9 to 10, 11. It doesn't seem very reliable for a long term. And a lot of times, chip companies are really hard. It's really hard for chip companies to maintain their dominance over time. Like Intel used to be the best, and now they're almost one of the worst. So I don't know. For me buying, I want to buy something that I know in 10 years is going to be still dominant and still around, and that's pretty dangerous. Like, let's look at some of the market movers. The ones going up the most. CarMax. What are some of the things that these have in common? I don't see anything in common with these. One's going down the most. Oh, Axon. Axon is a company that does the video for police forces. So they store, I think they give away the tasers and stuff that they charge for maintaining the video for the police force. And that's like a recurring revenue thing we looked at before. Let's look at Biogen. A lot of times drug stock, they go up and down based on competition and whether or not a drug is approved. Invitation Homes. This company, Invitation Homes, they basically bought a lot of single family houses and they're renting them out. And it's really interesting. I guess they could pay good dividend, but they're let's see what other stocks are interesting here. VFC. VFC is a apparel company. They VF Corp. I think they make the Tommy Hilfiger brand and a lot of other types of shirts and apparel. They went down a lot during the pandemic because of the lack of demand when no one went out and everything was closed down. Meta is still going up. It's like almost every day it's continuing its rise up. Let's look at some of the stochastics on the stocks we're following, just for kicks, because we like to do this every now and then. Okay. Right now, seems like we have this level of resistance for every one of the stocks, the indexes and stocks we're following. What I'm looking at right here is just this pattern we're just following. This is the communication sector is the only one that's breaking out. Every other one, healthcare, is kind of dragging along. Okay, so it doesn't look like we're the only ones that are doing good. Let me see. The only ones doing good this year are the tech stocks, and drug stocks are not doing good. All right, let's look at Meta. There it is. You can see that Meta is making like an all-time high every day. It's one of the most undervalued it has a PEG ratio of like 1.3, whereas the other stocks we're following, look at this, the PEG ratio is 1.9. Oh, it's a lot higher than I thought. Alphabet is 1.5. So you can see these big tech stocks are overvalued by like 50%, but they keep going up and there's momentum in the stock market. Let's look at more of these market movers. NASDAQ. Anything that groups these together. Nope, don't see anything in common. Okay, so we have energy, we have Meta, which is tech, Intel, Intuit, Adobe. Don't see any patterns there. Okay, let's look at the front page of Yahoo Finance to see what's really going on with the stock market. Stocks sink, on track for losing week. Okay, so we were talking about last week how we're overbought, and yeah, we went down like a couple percent, maybe 1 or 2% this week. But what's happening? We're down, last couple of days we've been down at the beginning, and we're rallying. So there's a lot of buying pressure, a lot of buying the dip mentality. Last year we had sell whenever it went up, and now it's a little bit different. Let me see. Okay, let's go back to our talking points. All right, so we have in our meeting notes, let's look at some of these other GARP stocks. GARP usually indicates that it's growth at a reasonable price. That means it's growing at 10% and its PE is 10. That's like a growth at a reasonable price. If it was a PEG ratio of greater than 1, that's not a reasonable price usually. But yeah, Qualcomm, it's not, their customers aren't reliable. China is not paying them for their IP, and then they might lose a contract to Apple for supplying their devices, and I don't know. But they're trying to diversify though. That's a good thing about that company. Let's look at some of the applied materials. They're supplying the chip industry, so there might be maybe an AI play if there's enough companies using their materials for processing the new chips. You see, and we found these 3 insurance companies in there: Cigna, America, AIG, and Chubb. But that's kind of outside of what I understand, so I'm not going to go over those anymore. You see, let's look at UPS. UPS is like, they have a duopoly with FedEx in America, and Amazon is kind of getting a little bit of that. Let's look at UPS and see if it's, Jim Cramer really likes this stock. He likes the person who's running it. So let's look if it's overvalued. $2.42. So its return on equity is great. Its profit margin is 11. That's good. But its PEG ratio is 2. That means its PE is 16. That means it's only growing at like 7%. So I guess how much can you grow if you're a shipping company? The economy has to be doing really good. Whenever you have a possible recession, you have oil prices going down, you have this 2-year and 10-year showing that we could be going into recession. This stock will probably go down if there's less demand, if there's a recession. So let's look at the earnings. So according to, so it's not growing a whole lot. So that's a 10.74 divided by 1 point. So it's growing 9% this year to next year. 11.83 divided by 12.68, 7% between 24 and 25. And 9% after that. So it's grown at 7%, and its PE is at 16. So that's where it gets its 2 ratio. You divide the PE by, it's only grown at 7%. So the reason why it sells at this premium is because it's consistent. It consistently earns the same amount on a regular basis. So it's growing a little bit, 7%, but it's not, there's a steady demand. So if you look at the chart, let's look at the chart. It's not that exciting for me. Look at the full screen. So it does pay a dividend. It went down a lot during the pandemic because the whole economy went down to nothing. But it's done really good since then. But let's look at right now it's oversold. You can see this is one of the only stocks that we're looking at today that's oversold. And if you look at this levels of support. Right here is the next level of support. We have support right here because it dropped to here before, and there's support here. Next level is here, because you have support way back here at this level. And then if the stock continues to drop, it'll probably go back down here next. That's the last level. That's the year 20. That was pandemic level. So it looks like this will stop going down right here, because that was last year, 2 years ago at this time. It just doesn't seem like a very exciting thing. Right now, you don't have any margin of safety. Margin of safety is that if it's trading at a PE of 14, and let's say it's growing at 28, then you have a 50% margin of safety. But right now, you have a negative 50% margin of safety. That means maybe if it goes down here, it'll be fairly valued, but it doesn't seem very exciting to me. I guess the only thing you could do as a trader is you can just wait for it to go down this low stochastics and buy it and then sell it when it goes up to here. But I don't like doing that. I like to buy and hold. So that was an interesting diversion. Let me see. All right, what else can we look at? Let's look at let's look at some of I like to review this every once in a while. Playbook for surviving crashes. This is important thing whenever you're watching the stock market. We don't have any control over major sell-offs in the stock market, but you do have control over if you sell or not. And the stock market is 90% of the stock market is based on automated trading. So if the stocks are going down, a lot of times quality stocks go down with everything else, and you have to be able to determine at that time, is this going to be affecting the stock that I own, this news story, whichever's with the sell-off. And for me, I like a 10-year horizon. And one of my best person that I listen to a lot is Warren Buffett. He basically says if you have a plot of land, you don't go and get a quote for it every day. It yields maybe 10 bushels of corn every year, and a certain amount of yield for your farm. You don't really buy a farm so you can trade it for $20 more tomorrow. So that's kind of the way I'm looking at buying and holding stocks. So let's look at where we are in this S&P. We made a low let's see, right here, this is the crash of the COVID crash when the whole economy stopped. We didn't know if, the economy would open up again. And you can see that it crashed. It recovered like half of the huge drop within a month or two. And usually when there's crashes, you have this dynamic of automated selling. And as soon as all the automated selling exhausts itself, there's no more sellers, then everything turns around and there's short covering. So you just can't get sucked into selling whenever there's a huge sell-off. We're due for it. If you look at all these lower highs, lower lows, we're due for another like low right here. So don't get too upset whenever it goes down. Um, that's a good point to look at every now and then. But whenever you sell a stock, you got to pay 20% like capital gains usually on whatever you make. So if you make money on a trade, you have to get the next thing that you buy has to be 20% better than what you're currently holding, which is really hard to do. And let's see, that's a good reason not to sell and to buy and hold. This is the last thing I'll go over. This is pretty much the rationale for my stock screens that we did today, and the stocks we're looking for. I have a growth mentality. I like to buy stocks that are trading undervalued and hold them long term, that are still growing. And this is the bottom of the notes that I give out every week. The annual earnings estimates basically says what the consensus estimates are for the stock. And I divide these numbers. That gives me this year's, next year's growth, and then this year's the next year's growth. And you want to have this growth to be at least 10% for growth stock and consistent. And you want this to be in a straight line up, like this red line. And these things here are like the most important statistics for a stock. You want a low PE ratio relative. A lot of times you have to pay higher for quality stock, but you want a stock that's a little bit higher market cap because it's more reliable. Return on equity shows how efficient a company is, and profit margin shows the same thing. And growth rate, that's what we determine here. It has to be over 10 for me to look at it. And if a stock is trading below or at 1, a PEG ratio, that is something that's on sale or fairly valued, or GARP, growth at a reasonable price. And so these are highlighted here are the things that I'm looking at: the market cap, the forward PE, the PEG ratio, and profit margins. We go over these every week when we're looking at a new stock. The total debt is something you don't want the total debt to be large compared to the market cap. Unless they're in an industry like banking where you have to borrow money all the time. And the dividend is important because you always add that to your total return. And that's always good to review those things. Another thing is you have to be willing to have volatility and expect it. You can't get scared out of the stock market. The longer you hold a stock, better your chances of winning and have a positive return, or more than positive. So you have to expect that sometimes a year the stocks dip 3% or more. Then you have 3 times a year 5% mild correction. Once a year we have a 10%. And volatility is the cost of being a grown up in investing. And so you have to pretty much ignore, what the people say on TV. And whenever the 15% severe corrections happen, you have to be willing to buy and hold. So, in general, when in the stock market, you usually have like 5 up years, maybe one down year. So you have more up years than down years usually. So you have to expect to live through the bear market like we did for the past year and a half or so. So it looks like things are coming back now. So that's good. And you see, the other good things we can get. Okay, these are some examples of Warren Buffett's portfolio, and you can see that Apple is his top holding. It's been his top holding for a long time, but it says 4.5%. It's basically 20% of his investment portfolio, but it's only maybe 2% or 5% of his total investments because he has private companies that are worth more than all of these. You see, so a lot of these companies that are in the top 50 stocks that he owns, they have a high moat. It's really hard to catch them because they have a high large moat, and they also have a strong demand that will be here 10 years, 20 years from now. So people will still be banking. There's a lot of banks. They'll be still eating ketchup 20 years from now. So at least you'll have these companies that will be still relevant. And I think that's one thing that's consistent throughout his portfolio. So that was an interesting diversion. If you have anything you want to say or questions you have during the week, let me know. I think I've exceeded my time. Thank you very much for attending.